Okay. Give me a... Okay. All right. So let's go to the quiz. And I think we had gone through, pretty much everything except for I think it was the last page. Correct me if I'm wrong. These two.
Yeah, just the last page.
Yep, got it. Thank you. So what we're going to do now is we're going to underwrite a development project, and then we're going to do a bunch of these, on the midterm. So it's all going to be problems when we get to the midterm. Okay. Any questions or comments before we get started? Okay. So let's see. So what we're going to do is, it's going to be a real estate acquisition and development. If a commercial real estate asset has net operating income equal to $100 million and is expected to grow at 10% in year 0 to 1, then 8% from 1 to 2, 5% from 2 to 3, and 2% from year to 4, the pro forma income statement forecast period is 3 years, so we're a developer, or we're going to acquire a property and we're going to redevelop it or develop it, and then we're going to add value over the 3 years, and then we're going to flip the property and sell it at the end of the third year. Our expected return, which is the discount rate, is 22%. And is expected to stay constant over the holding period. What is the intrinsic value of the asset, the present value? If we could acquire the asset for $2 billion today, what would be the present value, net present value, and the break even? What is your acquisition and development recommendation? So the first thing we're going to do is we're going to calculate the present value. And we're going to use the net present value approach to do it. And it's a development, or it's an acquisition. And what's the holding period? What's our holding period? How long do we plan on holding this before we flip it out? Travis, Anthony, Nico, Nicole, what's our holding period?
Is it 3 years?
Yeah, it is. Okay. So year 1, year 2, oops, year 3. And then when we use the discounted cash flow, do we need to grow it out one more year?
Yeah.
Yeah, and why would we grow it out one more year? What do we need to calculate? I mean, if you have your notes from last week, you can use those too. What do we use the fourth year's cash flow for?
For the start, like of it's the beginning balance, right?
Well, no. Why do we need to grow out the cash flows one more year, and then we're going to do something to that cash flow to get something? What are we trying to do? If you have your notes, you could just go back to your notes, because I talked about them on. I talked about that methodology on the intrinsic valuation theory on page 3. And I also talked about it on page 2, when we were talking about discount rate determination. So do you have your notes? Do you guys have your notes? I mean, did anybody take notes?
I took the notes and have them with me tonight.
Okay. Anybody else have their notes?
I didn't. No, I'm sure. I didn't show up the spot, so.
Okay. So test question. If you're working on a project and you're called into a subsequent meeting, would you bring the notes from the prior meeting into your meeting?
Yeah.
Yeah,
Yes.
you would. Yeah. Okay. So here are the notes that I took from our business meeting the other night with the company that I work for. So here's my notes all typed up. You don't need to type them up, but I got all my notes. Got all the notes. Notes, 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 notes. So you can refer to the notes. Okay. Anybody taking corporate finance? Anybody taking corporate finance?
No.
No, neither one.
I think so.
Not me.
Did anybody take corporate finance?
Mm-mm.
No?
No.
So no notes, no corporate finance. Did you watch any of the videos? I just need to know where we stand, that's all. So you can say nothing, which means no, or you can say nothing, which means no, or you can just tell me no.
No.
Okay. My recommendation to all of you is to be honest, because if you don't say anything, that means you don't know, and you'll get fired. And if you say something like you say yes, and it really means no, they're going to fire you anyway. So just let me give you a little tip there. Okay. So let's, since we can't answer that, let's just figure it out. So what's the cash flow that we're going to use to value this property? How do you value real estate? What's the cash flow metric that you use? How do you calculate the value using the income capitalization approach? Can you Google income capitalization approach? Can you look up cap rate?
Is it the NOI?
Yeah, exactly. Okay, so we're gonna use NOI. Okay, so what's the first year NOI?
100 million.
Got it. Okay. So 100 million. Got it. And then what's the growth rate on the net operating income for the first year? It's all right there.
I'm sorry, which number are you looking for?
My question, and remember, I have 1, 2, 3, 4, 5, 6, 7, 8. I got 9 analysts. Okay, 9 analysts working on this problem. So it's all right here. So participation is good. Okay. So what's the growth rate on the net operating income for the first year?
10%.
Got it. So what do I have to do to that 100 million to get the first year's net operating income? Didn't we do an example of this? Didn't I do a discounted cash flow example last class?
Yeah, towards the end.
Yeah, so do you have those notes, Richard?
I'm looking over them at the moment. I think I've made a mistake somewhere and I'm not exactly understanding what I've done wrong.
Okay, do you know how to grow out something?
Give me 2 seconds.
Do you know how to take a future value factor? Do you know how to calculate a future value factor?
Do we multiply it by the percentage or divide
So
it by the
so
percentage?
you're going to multiply it by what? So if
Well,
I
the first year was the 10%.
yeah, but what do I
So it's the interest rate. Isn't it the interest rate times the time period?
1 times 1. Is that what you're saying? 0.1 times 1? How would I grow out the 100,000 by 10%? If I want to get next year's what is it?
Multiplied by 1.1.
Yep, got it. You guys all.
Oh, add one. Add one. I got you.
Yeah, you guys need to know this. Okay. Got it. So what's 100 million times 1.1?
110 million.
Got it. Okay. Now this first problem is going to be excruciatingly painful, but I'll promise you, if you take really good notes and review your notes from last time, when we go do 9 of these things, by the time we're done with 9 of them on the midterm, you'll totally understand. Okay, so how do we get year 2 net operating income?
It says 8%.
Got it. So what do I multiply the 110 million by?
1.8. 1.08.
Got it. 1.08. Thank you. So what's 110 million times 1.08? And you guys should all be doing this on your calculators. You can't do it in your head, and if you just write down the answers, you'll never know how to do it. Okay.
118.8 million.
Thank you. So 118.8. Got it. And then how do we get year 3?
That one is 5%.
Got it. And then what's the future value factor that we use?
By 1.05.
Yep, got it. So 1.05. So what's 118.8 times 1.05?
124.7 million.
124.7, got it. Okay. trying to calculate the present value, right? Under the DCF. I have to sum, in this case, the NOIs over the holding period divided by 1 plus I to the n. And then, what's the other cash flow that I need to include?
I'm not sure.
Am I going to sell the property at the end of the third year? Am I going to sell this property at the end of the third year?
Yeah.
Yep. So I need to calculate the terminal value. Okay. That's why we need the fourth year. Okay. So what do we need to grow the third year NOI out by to get the fourth year?
Well, the last year says 2%.
Got it. So I would multiply it by what?
1.02.
Got it. Okay. So what's 124.7 million times 1.02?
127.2.
Got it. Okay. Excellent. And do we think that the cash flows are going to grow, for the next, 10, 20 years?
Probably not.
Then why would you buy real estate?
They'll go up with inflation.
Yeah,
other
exactly.
things.
Yeah, probably go up, by the inflation rate. So we could use the inflation rate in this case as the constant growth rate, because you're going to use the Gordon growth of the constant growth model to get the terminal value, because you're assuming that the cash flows are going to grow at a constant rate, not remain flat. If they're going to remain flat, I'm going to use the perpetuity model and just use my expected return to get the terminal value. But if I think the cash flows are going to grow at least at inflation, then I got to adjust for the inflation rate, for the constant growth rate in the cash flows forever. So what's 0.22 minus 0.03?
0.19.
Got it. And what's 127 million 0.2 divided by 0.19?
I'm sorry, which numbers for this one?
127.2 divided by 0.19.
$669,000.
No, you mean million.
Oh yeah, that's what I meant. Sorry.
Yep, that's cool. All right, so there's our terminal value. Now we gotta, work on the rest of the equation and discount the cash flows. So what's the discount factor that we're using? What's the discount rate that we're going to use to discount the cash flows, the NOIs? We already talked about it. So what am I investing in here? What am I buying?
Commercial real estate.
Yep. And then, do you buy a piece of real estate for free?
No.
Do you expect to get nothing from it?
No.
So what would be the expected return here?
22%.
Yeah, and wouldn't I use that as the discount rate?
Oh. Yeah.
Yeah. It's all right here. You know, it's not rocket science. It's just there. So what would be the first discount factor? How would I set that up for here? What would be the discount factor? Well, it's got to be something, right? Right? Discounted cash flow, net present value. So how do what would the discount factor look like? Can you Google, you know, discounted cash flow? Look at the model. Tell me what the discount factor would be for the first year.
Would it be 1.22?
Yeah, exactly. 1.22. And what do I raise it to?
The amount of time.
Yeah.
So would it be 1 year?
Yep. And then what would be the second one?
The same thing, but to the second year.
Yep. And then what about the third one?
Same thing, but to the third year.
Got it. And then what's 1.22 to the 1?
1.22.
Got it. And what's 1.22 squared?
1.4884.
Got it. And what's 1.22 cubed?
1.8158.
Like that. If I round it to 2 decimal points. Is that correct?
I'm pretty sure it'd be 1.82.
Yeah, that last one is not 1.815.
Oh, okay. This one?
Yes.
Okay.
1.82.
Thank you.
Perfect.
Okay, awesome. Great. And then what is 110 million divided by 1.22?
$90 million.16. So 90.16.
We'll just make it easy. Okay, and then what is 118.8 million divided by 1.49?
79.7 million.
Are you guys checking these numbers? Is everybody checking these?
Yeah.
They're all right.
Okay,
Yeah.
thank you. And then what's 124.7 divided by 1.82?
68.5 million.
Got it.
Can you leave those there so I can write them down? Sorry, I've been calculating.
Oh, okay. Is that what you were looking for, Michaela?
Yeah, I just have been calculating and not able to write them down.
Oh,
at the same
okay.
time.
Go for it.
Thank you.
Yeah, you're welcome. So there's 2 ways to do this. One, you can add the terminal value to the last year's cash flow, and then divide it by the last year in the holding period's discount factor. Or you can discount the terminal value by the discount factor in the last year of the holding period. So we'll just make it easy and we'll just discount it by 1.82. And what's the discount of the terminal value?
So are we doing the 669 divided by 1.82?
Yeah, the 669 divided by 1.82. Yeah, because you have to, the theory is that you sold it at the end of the third year.
Mm-hmm. Yeah, so it's 367.6.
Got it, okay. And if I sum all these up, what would be my present value?
If you add them all?
Yeah. If I add the 90.2, 79.7, 68.5, and the 367.6, what would I get?
$606 million.
606 million, like that. So if I add these all up, I get
Yes.
606. Is that right? Is that correct?
Yeah.
Okay. And is that our present value?
Yes, at the discounted rate.
Yep, that's the discounted cash flow, right. Got it. And then how much is it for us to buy this thing?
Is it the 2 billion?
So the present
Is that-
value is 606.606 million. Got it. And how much does it cost? What would it cost us?
I don't know if it's the 2 billion or the 100 million.
No, the 100 million is just the cash flow in the first year.
Okay.
So how much would it cost us to develop this project or buy it?
Is it the present value?
No, how much would it cost us to buy the property? To acquire it?
Oh, 2 billion.
Got it. Okay. And what is 602 million minus 2,000 million?
How come it went to 602 million? Sorry, did I miss that?
That's okay. We grew out the 100 million originally. You know, the cash flow of 100 million, we multiplied it by 1.1.
Mm-hmm.
And we got the first year cash flow.
Yeah.
And then we grew it out by 8% to get the 118.8.
Mm-hmm.
Then we grew it out by 1.055% to get the 124.7.
Mm-hmm.
Then we grew it out by 2% or 1.02 to get the 127.2.
Mm-hmm.
Our expected terminal discount rate was 22%, and we assumed that the cash flows would grow at a constant rate of 3% forever. So 0.22 minus 0.03 gave us 0.19. So we divided by the 127.2 by the 0.19, and we got a terminal value of 669 or 669 million. And then we went over here and we took our discount factor. We took our expected return.
I got all of that, but what I'm confused about is how did we go from 606 million to 602?
Oh, sorry. Sorry.
Okay. No, you're good. I just didn't know if something changed.
Yeah, cool. Thank you.
Yeah.
So
The
what's?
final is negative 1,394.
I'm sorry. What is it?
Negative 1,394.
Got it. All right. So this is our present value. Right. This is our cost. Right. This is our net present value. if the net present value is negative, do we do it?
No.
No. Got it. Ugh. So the question is why is it so different? So where do you think you might have made your mistakes? You know, where in the equation do you think maybe you made your underwriting mistake? Because this is a pretty big number, right? So we probably made a mistake somewhere. Because the market's telling us that the property is worth significantly more than we're valuing it at. So where are we making our underwriting mistakes? You got to go back into the math and do an audit.
Return?
What?
I don't know if that's right.
No, go for it. No, keep going.
And the expected return, like, should it be more?
Well, if the expected return goes up, right? If I use a higher discount rate, what's going to happen to the present value?
Oh, it's gonna go up.
If this goes up, this goes what? If these get bigger, this is going to get
Smaller?
got it.
Okay.
So are we using too high of a discount rate, or should we be using a lower discount rate?
If we use a lower discount rate, then the present value will be higher.
Correct. So we probably overestimated. We probably overestimated the discount rate. So the project probably is not as risky as we assumed it would be. So we probably made a mistake in the discount rate. So we probably overestimated the discount rate. Got it. Okay. Got it. And here. Okay. Where else could we have made our mistakes? You got to go through the mathematics and basically run this equation in your brain to see where you probably made your mistakes. There's not a lot of areas here, but there's a few areas where I'm trying to teach you how to underwrite. So where else could we have made our mistakes? Are we trying to bring up the present value or bring it down? Yeah.
Maybe return rate?
We already did that. We already said that we probably overestimated the discount rate.
Oh.
So if we lower the discount rate, we lower the discount factors, and the present value goes up.
Maybe in the 2 billion.
Wait, say that again.
In the 2 billion.
Maybe. Maybe we could have overestimated the cost of construction.
I was thinking maybe the 1.82 on the right hand side, if you made that smaller.
Oh yeah. So if we bring down the discount rate, what happens to the terminal value?
Terminal value goes, or the 0.19 goes down. Yeah.
Yeah. If that goes down, what happens to that?
It goes up.
Yeah, exactly. So the terminal value goes up if we take down the discount rate. How else can we inflate the terminal value?
The 0.03.
Yeah, are we going to take it up or take it down?
Take it down.
So if this goes down, this goes
0.2.
down, or does it go up? So if this goes down, does this number go up or down?
that goes up to 0.19.
Yeah, so if it goes up, what happens to the terminal value?
Never mind. I got it reversed. My bad. You want the 0.03 to go up.
Got it.
Sorry about that.
Got it. Okay. Excellent. Okay. So we might have overestimated the discount rate, but we could have underestimated the growth rate. Okay, good job. Where else could we, if there's like two more areas where we could have made our mistakes? There's, there's not a lot of variables in the assumption, so, so all you got to do is kind of look through here and do a little process of elimination, some deductive reasoning.
Where it's expected to grow.
Yeah, the growth rate. So did we over or underestimate the growth rate?
Under.
Got it. Right. So if I increase these growth rates, what happens to the present value?
It goes up.
Got it. Okay. And there's one more. I don't know. This is extra credit bonus points for anybody who gets this. Can you figure out the one last variable that will affect the present value? Can anybody figure it out?
I would guess maybe time.
No. Usually time, is not a huge factor. What variables in here have we not talked about yet? What one variable? What is it?
The number of periods?
No,
Payoff?
I'm going to assume that the number of periods, because the terminal value theoretically is supposed to capture the value of all future cash flows. So it's not really the holding period. Could be argued, but that's shouldn't necessarily be the one of the factors that has a major contribution to the present value.
The holding period?
No, we're not going to. I said, theoretically, the holding period shouldn't have an impact because the terminal value theoretically captures the value of all future cash flows. So theoretically, it shouldn't be the holding period, but it is the. What is it? What's missing? One more in there. It's in the paragraph. Come on, you can do it. I know you can do it. I know you can find it. It's in there.
Is it the 100 million?
Yep. So, do you think we could have underestimated
Bonus points.
bonus points? Do you think we could have underestimated the initial year cash flow?
For sure.
Totally. And if we revise it upwards, what happens to the present value?
It would rise.
You got it. And then what would happen to the net present value?
It would shrink.
Okay, so if this goes up, this would go down.
Well, no, it would. Well, not. It wouldn't go down because then that would make it seem like a less of a negative number.
Yeah, so it would go up, wouldn't it?
Yeah.
Yeah, if this goes up, this is going to go what?
Up.
Got it. Life, like politics and economics, is just a game, okay? And there's rules to the game, and there's logic to the game. And if you learn the rules and you learn the logic, and you know what, when this goes up, that goes up, that goes down, that goes up, that goes up, that goes down. If that goes down, that goes down, that goes up, that goes down. If that goes up, that goes up, that goes up. I mean, it's a game, right? It's a puzzle. You learn the rules, you learn the game, you learn the logic, and then you win because you learn the rules of the game and the logic. And this logic is the standard logic that all bond investors, stock investors, real estate investors, they all use the same model. Okay, it's the same approach. Okay, and then the other one that you talked about. Do you think that we could have overestimated the development costs for the building?
Yes.
And if we could reduce the development costs, what would happen to the net present value?
Would it increase?
Yeah, it would increase. So if I'm getting this huge negative net present value, then we're doing something really wrong. So what we need to do is we need to go back and do the research, come up with a more realistic initial year net operating income. We probably underestimated the growth rate in the cash flows. We probably used too high of a discount rate or expected return, not only for the cash flows over the holding period, but also for the terminal discount rate. We probably underestimated the constant growth rate or the terminal growth rate for future cash flows in the future, and we probably overestimated the development costs. So now you guys got to go back and re-underwrite this thing and come back to the investment committee and re-present it again. And if you still get a negative net present value, what's your recommendation?
A -1 would still be to reject.
Got it. And if we come back and the net present value is positive,
Then accept.
then we would accept it. Got it. And if the net present value is 0,
We would also accept.
got it. Okay. That's it.
Whoop.
Okay. Now that was pretty easy because we have some other ones that are a little more difficult on the midterm. But by the time I'm done with the midterm, you guys will totally get it. Okay. All right.
You can if you want on the thing.
All right. Any questions on this? Anybody have any questions for that problem?
Questions?
You guys good?
Yeah, it was clear.
Okay, cool. This is also called capital budgeting in finance. It's called investment analysis. It's called investment decision making. You can use it. This was a real estate example. We could use it to go through the same underwriting procedure for acquiring companies.
This was definitely easier this go through than last week's go through.
Yeah, the first time's usually the hardest, and then after you go through it a bunch of times, it gets a little bit easier.
Yeah.
But it took me a long time to figure all this stuff out, and then I had to figure out how to teach it. And you'll probably have to teach a board member, that has political ties to the city that sits on the board but wasn't trained in finance or accounting. And you'll have to explain it to him or her. And you'll probably have to get up on the board and diagram this stuff out. Maybe not an example like this, but you might have to schematic some things out, because some people, they learn visually. Sometimes they just don't get it when it's in black and white. So you got to kind of draw it out, for them so that they understand. And then the last one is the investment decision-making matrix. And I usually have like a big board to write this thing on, so I'll do the best I can to jam it into this space. this is, I call this the investment decision making matrix. Okay.
Can you read off what that top line says?
Yeah. This is called investment decision making matrix. This says rules right here. This says iteration number 1, and then I abbreviated iteration number 2, iteration number 3, and iteration number 4.
Perfect, thank you.
So what I figured out is that when you're making investment decisions, you got to go through at least 4 iterations before you make your final decision. The last example, it was just, is the net present value positive, 0, or negative? This one, you have to go through 4 iterations because we're talking about millions or billions of dollars in investments. So you want to make sure you're making the right decision. And again, this is also called capital budgeting. Okay, awesome. I got it to fit. Okay, so what I'm going to do is I'm going to ask you some questions, and then you're going to give me the answer. And usually what I do if I'm in a class is has anybody been to the Castro Theater in San Francisco?
No.
No? Oh, it's like this old, movie theater, and right around Christmas time, they have The Sound of Music plays, but it's a big sing-along. So everybody comes to the theater, you know, and then they sing along to the Sound of Music. It's quite adorable.
The rock show.
Yeah, it's like Rocky Horror, but you're not yelling out stuff at people. You're actually singing, you know.
Things.
Yeah. So this, we were in class, we would be singing along to Larry's finance Sound of Music thing.
Hey, Professor.
Yeah.
Real quick, for the third row, IRR,
Yeah.
what are the last two things after IRR?
Yeah. Let me go through them. Okay. So this is that's okay. I appreciate it. This is the present value of the cash flows is greater than the cost of the acquisition or the development cost. The present value is equal to the price of the cost. The present value is less than the price of the cost. The net present value is positive. The net present value is 0. The net present value is negative. The internal rate of return is greater than the expected return, or the discount rate, or the weighted average cost of capital, whatever you're using as your benchmark or your hurdle rate. The IRR is equal to expected return. The IRR is less than the expected return. And then here, another investment decision making matrix that some investors use is, will I reach break even in less than 10 years? So I take the cost divided by the cash flows. When am I going to reach break even? Is the break even equal to 3 years, or is the break even greater than 3 years? So
Thank you very much.
So you'll see how this, you'll totally get this. Okay, so all of you should participate and test your knowledge. So if the present value is greater than the price of the cost, would you accept or reject it?
Accept, right?
Yeah, everybody should be like accept. You know, I should have like 6 accepts. So let's try a mini virtual Larry's finance sing along. So if the present value is greater than the price of the cost of development, would you accept or reject?
Accept.
Accept.
Awesome.
That wasn't really in tune.
Yeah, that was.
Accept.
Well, let's try the next one. So if the present value is equal to the cost of the price, would you accept or reject?
Accept.
Yeah, that wasn't very good.
So.
Try again.
If the present value is less than the price of the cost, would you accept or reject?
Reject.
Got it. Excellent. If your net present value is positive, would you accept or reject?
Accept.
Accept.
Got it. And if your net present value is 0, would you accept or reject?
Accept.
Accept.
And if your net present value is negative, would you accept or reject?
Reject.
Reject.
Got it. And if your internal rate of return, did somebody have a question? Okay. If the internal rate of return was greater than your expected return, or your discount rate, or your weighted average cost of capital, would you accept or reject?
Accept.
Accept.
And if your IRR was equal to the expected return, would you accept or reject?
Accept.
Accept.
And if the internal rate of return was less than the expected return, the weighted average cost of capital, or your discount rate, would you accept or reject?
Reject.
Reject.
If your break even was less than 3 years, would you accept or reject?
Accept.
Accept.
Okay. And if your break even was equal to 3 years, would you accept or reject?
Accept.
Accept.
And if your break even was greater than 3 years, would you accept or reject?
Reject.
Reject.
Boy,
So do you see the logic here?
Yes.
pretty easy. Yeah.
So here's the key right here. If you know any one of these, then you know the other. Okay? So if I know that the present value is greater than the cost or the acquisition price, I know that the net present value is going to be positive. I know that the internal rate of return is greater than the discount rate, and I know that the break even is less than 3 years. So if I know one of them, I know the other three. This is what's going to happen when you're in the investment committee meeting. All of these people are going to know this stuff. And then if the present value is equal to the price, then we know that the net present value is going to be 0. We know that the IRR is equal to the expected return, and we know that the break even is equal to 3 years. And then lastly, if we know that the present value is less than the price or the cost, and then we know that the net present value is negative, we know that the IRR is less than the discount rate, and we know that the break even is greater than 3 years. Okay, that's your first iteration. It's pretty simple, right? But what happens if you, like in the last case, that we have a project and we're getting a negative net present value, and the senior level managers and the investment committee and the board of directors really want that development? They're going to tell you to go do something right off the bat, which is iteration number 2. So you're the head of acquisitions. The investment committee chair tells you first thing that, because you presented the deal and it has a negative net present value, the first thing that's going to come out of his or her mouth is, you need to go back and do what? What's the easiest thing to do to get the net present value positive?
To have the present value be greater than?
Yeah, remember in the last example, the net present value was negative?
Yeah.
Yep. So before you go look at any of your old assumptions or anything, what would the chairman of the investment committee ask you to do? They'd want you to go back to the seller and ask for what?
If the present value is greater than the cost.
Well, let's say it's an acquisition. So I got a negative net present value. I present the deal to the board. They say, well, we really want this deal. We need you to go back to the seller and ask for what? That will get the net present value up. Now, go look at the equation that we just went over.
Value?
We'd have to do what?
Get a higher present value?
Yeah, based on that net present value calculation, the chairman of the investment committee, or the chairwoman of the investment committee, said, hey, Michaela, what I need you to do for us to do the deal, we need you to go back to the seller and ask for what?
Oh, so we talked two of them, the value going up or the development cost going down?
Correct. Correct. So what would we go back to the seller and ask for?
A different discount rate.
Now, the discount rate is determined by us. How would I get the net present value up? I got to go back to the seller and ask for what?
A different sales price?
Yes. Am I going to ask for a higher sales price or a lower sales price?
Lower sales price.
Got it. In what amount?
in one that is lower than the present value.
Lower or equal to?
Correct. So I'm going to ask for a price reduction in the amount of the negative net present value.
Can you read off what those say when you
Yeah, it
write
says
them?
ask for price reduction in amount of negative net present value. So if I can get a price reduction in the amount of the negative net present value, then what's the net present value?
0?
Got it. And would we accept or reject it?
Accept.
Got it. That's the first thing you're going to need to do. Now, do sellers like to give you lower prices?
No.
Do some sellers give you lower prices?
Some.
What if the seller says no? Do sellers ever say no?
Yes.
So what would you do if the seller said no? What's the third iteration that you would need to do? Because the board and the investment committee really want this deal.
Would it be in regards to the rate of return?
Yeah, and we would go back and look at the rate of return. So what would we have to do?
We want a higher rate of return.
Do we? Were we using too high or too low of a discount rate?
On the last problem, the discount rate was too high.
Right.
We would want a lower discount rate.
So if we're getting a negative net present value, would we have to lower our return expectations or increase our?
Yeah, lower the discount rate.
Got it. So we would have to review our expected return. Got it. And then how many expected returns did we use in the calculation?
For the last one,
Yeah.
it was 3 years and then the fourth extra year.
Yeah, exactly. So you'd have to look at the going in discount rate and your terminal discount rate.
What did you write in that top box?
That says review assumptions.
Okay.
So just like we did, in the first problem, we went back and reviewed all the assumptions. So you need to regurgitate all those assumptions that we just went over so I can ingrain it in your brain.
Yeah.
So we'd have to go back and look at the expected returns, not only the going in discount rates and factors, but the terminal discount rate. What else would we need to look at? We just went through all of these like 10 minutes ago. So if you took notes, then you have the list.
And we talked about the development cost.
Yeah, we would have to review the development cost, right? Because we might have overestimated that. Now, I'm sure you guys wrote all the notes down, so you just got to flip the page back and go down the list.
And so we talked about the present value at a different rate.
Yeah,
Discount
That's right there. Got
lower
it.
discount rate.
Got it. Right there.
Cost.
The what?
The different development costs.
Got it. Right there.
trying to find where the other one.
Oh, with the expected return,
That's what that is right here.
isn't that the discount though? Because aren't
Yeah.
they two different numbers?
Uh,
There's the grow number, and then there's the return number.
correct. So, what are some of the other factors, assumptions that we would need to review?
Oh, it wouldn't grow as much, maybe?
Yeah, the growth rates.
Mm-hmm.
Got it. And where did we use the growth rates? There was two places we used the growth rates.
From year to year.
Yeah, so we used them in the pro forma. Over the holding period. And then where was the other growth rate assumption?
The terminal value?
Yeah, we used the terminal growth rate. Okay. Any other factors? Remember the extra bonus point?
Oh, the extra bonus point was the development cost.
No, the well,
Present value.
It was the 100 million, right?
yeah, and that's what isn't that the initial cash flow?
Yeah, what they're selling it for.
No, it's not what we sold it for. It's the initial cash flow.
Yeah. What's coming in?
Okay. Is that all the assumptions that we used in that DCF model?
I think so.
Okay. So did we over or underestimate our expected return? Did we use too high or too low?
We had too high.
Too high. So did we over or underestimate it?
Estimated.
What'd you say?
Overestimated.
Yeah, we overestimated it. Got it. And then for the development costs, did we over or underestimate the development costs?
We overestimated.
Yeah. And then for the terminal growth rate and the pro forma growth rates on the cash flows over the holding period, did we overestimate the growth rates or underestimate the growth rates?
Underestimated?
Exactly. Okay. So you got to go back and re-underwrite this thing and check your assumptions to make sure they're correct. Okay. So you go back, you re-underwrite everything. It looks good. You go back to the board, you go back to the investment committee. We're still getting a negative net present value. It's like Nicole, Arlene, Jordan, Michaela, listen, I've talked to the board, the senior management. They really like this project. They really want to do the project. You need to go back and do one more iteration. And the last iteration is you need to value what is called a real option. Okay? You need to calculate the value of a real option. Okay? And it's actually the calculation of the value of a real call option is what it is. Now there's two ways to calculate the value of a real call option. Is the Black-Scholes method and the binomial tree method. And Merton and Scholes and Black and all of those guys in the 70s invented these option valuation methods and won Nobel Prizes. So you need to calculate the value of a real call option. What are the factors that drive the value of real call options? Well, one is time, okay? So this project, a lot can happen in 3 years. So just that amount of time adds value to the real call option. It's called time value. The other factor is volatility in the value of the underlying asset. So the longer the time period you have, and this is my acquisition price right here. And this is the value of the property.
Camera down a little bit.
What'd you say?
Can you lower the camera down a little bit? Thank you.
Like that? Is that better?
Yeah, perfect. Thank you.
Cool. So in Silicon Valley, for example, or the Bay Area, due to the influence of technology and tech jobs, do you think that the volatility in value of real estate is high or low?
Hi.
Yeah, exactly. So the longer the time period and the more volatile the valuations are, there's a higher probability that the value of the property or the development is going to be significantly higher than the cost of the acquisition or the development cost. So it's the volatility. And anything above the acquisition price is called an in-the-money option, which means that's your value. So the volatility has a major contribution to the value of the option. The other is management's decisions. Now, when you're acquiring a building or developing a property, does management have a major contribution to the value of the acquisition and the value of the development?
Yes.
Yeah, because they can wait to develop. They can move quickly to develop. They can design the building. They can design the amenities. They can pick the materials. They can select the tenants. There's all these management touch points within the process that actually adds value, not only to the property, but to the option, the real option. So management decisions. So if I'm trying to make a decision and I'm now adding the value of the real call option to my capital budgeting or my investment decisions, the question is, what's the value of the real option need to be for us to accept this project? So you guys, since you're all finance, accounting, real estate, smarty pants majors and students, the executive team said, well, you need to go try to quantify the value of this option, this real call option, because we know that there's value in this project that's not being reflected in the discounted cash flow model. So we need you to try to quantify it. So we go ahead and we calculate, because we took, investments class and financial institutions, and so we know how to calculate a call option or a real option. So we calculate the value of the real option, and the value of the real option so the question is, we're now getting a negative, I got a negative net present value. Right? And under normal investment decision making and normal capital budgeting decision making, would I accept or reject the project? We did the first leg of the analysis and we came up with a negative net present value, and our recommendation was what?
So if it's a negative net present value, then we reject.
Yeah, exactly. But if there's a real call option value to this, what does the value of the real call option need to be to get a positive or a zero net present value?
It would need to be greater than the net present value.
Yeah. So it's got to be greater than or
equal to.
Got it. And if the value of the real call option is greater than the negative net present value, then your net present value is what?
Positive.
And would you accept or reject it?
Accept.
Got it. And if the value of the real call option is equal to the negative net present value, then your net present value is what?
It's greater than?
Yeah, if the value of the real call option is equal to the negative net present value, then your net present value is what?
0.
Got it. And would you accept or reject it?
Accept.
Got it. And if the value of the real call option is less than the negative net present value, then your net present value is what?
No.
It's going to be what?
Negative. And you would reject it.
Got it. Okay. That's it.
Yay.
Okay. So that's, that's the way I look at it. That's the way I develop this. To train myself to be able to make investment decisions. I developed this logic to be able to make investment decisions and be able to sit across the table in an investment committee, a board of directors, senior level management with other acquisitions, development, personnel, asset management, finance professionals in the firm to walk through the process and make sure that we're not making a mistake over here, that if we could get a price reduction, that's great. We can do it. But the seller usually doesn't like to reduce the price. And then I got to go back and I got to re-underwrite and check all of my assumptions to make sure they're correct. And if I still get a negative net present value, then I got to calculate or at least walk through the thought process of valuing a real call option, because the capital budgeting process only captures this. It doesn't capture the volatility. It doesn't capture management decisions, and it doesn't capture the time period, the ability to make decisions to, push the project forward or maybe delay the project. So there's some timing optimality there that adds to a value component that's just not reflected in the underwriting process. This valuing of the call option is intuitive for most investors that have been through multiple cycles, but I believe it's theoretically correct. It's application correct, and most of the professionals would say, I've been around a long time. I know the market. I know the cycle. I've got 30 years experience. My gut tells me that this is a good deal. This quantifies it and then formalizes the process and takes it out of being a gut feel into more of a decision-making process and a rules-based and a scientific approach as opposed to a psychological approach to investment decisions. Okay, I think that's all I got for tonight.
For tonight?
Yeah, that's all I got.
All right.
Professor,
Yes.
would you mind if you raised the camera to see the board one last time from maybe a better angle?
Yeah, absolutely.
Thank you very much. I appreciate it.
Like that? How's that?
Oh, that's awesome. Oh, that's actually perfect. Thank you.
And then there's the one down below.
Could you just read me the last sentence on the very bottom right-hand corner of the top board?
Yeah.
Sorry, Professor?
Yeah. So right here, it says value the call option.
Yep.
Is greater than or equal to the negative net present value.
Yep.
Equals the net present value.
Yep.
So it's if it's
yeah,
plus or
I
zero,
that.
you accept. If it's negative, you reject.
Oh, awesome. Thank you very much.
Okay. Any other questions? All right. So. Okay. So like next week we'll do more midterm stuff. We'll do some student presentations, and then I think there was one more. Oh, and then we should talk about the papers.
How do you want to do the student presentations? One person share their monitor and then...
Yeah, and then you could just go back. Yeah, then, you
okay.
You just go back and forth.
Cool.
Yeah,
thanks.
We'll share screens and stuff like that.
Awesome, thank you.
Okay. Anybody else? All right, well, I got to go eat leftover chicken.
Sounds good.
See you next week.
All right.
Thank you.
Have a nice night, Professor.
Yeah, I'm around on the weekend and next Monday, and then I'm available early in the mornings next week, and then later in the afternoons if you want to set up a one-on-one Zoom.
Oh, cool.
Thank you.
Yeah,
Appreciate your time.
you're welcome. My pleasure. That was fun.
Thank you.
Hope you're staying safe, Professor.
You too.
Have
You
a good
guys.
one.
Thanks for everything.
Professor, thank you.
All right, Anthony. It was nice hanging out with you.
Okay, we'll have our project due. I mean, it is due next week. We'll have it done. 20 minutes. It's supposed to be.
Yeah.
All right, perfect.
Yeah. And if it's
Presenting our 2 chapters, right? Yeah.
Yeah, I have 3 teams that are going to do a chapter each, roughly, 15, 20 minutes each. So if you got 2 chapters, you can do it like the following week or something.
Oh, okay, perfect.
All right, cool.
Sounds good. Be safe.
You too.
Great.
It was nice talking to you.
Yeah. See you next time.
Okay, take care.